Very good afternoon, a very good morning. Welcome to HYCM's workshop with myself, Giles Coughlin. I will now be outlining for us exactly what we can expect as we head to the rest of the session. I'm going to be putting this latest market dynamics into context so we understand what's going on. I'm also going to show us the best potential trades out of the crisis. I'm also going to be outlining what we're expecting the ECB meeting to do tomorrow, as well as some potential opportunities that we have heading into the meeting. Now, just don't forget, as we look at different entries, exits, different trade ideas, the whole idea of this webinar is not a trade signal service. The whole idea is that you look over my shoulder, someone with a professional trading background, and you see how I go about making decisions, managing risk, etc., etc. So we will be, looking at trading the ECB rate meeting. I'm also going to show you demonstrate how to go about trading in a very basic fashion, so that you understand conceptually what's going on. So buckle your seatbelts. We're in for a ride. Make sure that if you've got any questions, this is your opportunity. Put it in the Q&A box or the chat box, and I'll either try to answer it as we go along or get to it at the end. So without further ado, let's get going. Right, what I'm going to do is, before I show us what's going on, I'm going to take a different approach today. I want you to understand that when you're trading, this image is central to understanding what we're doing. If you see those images, you can see that there's a strong arm and there's a weak arm. Now, which arm would you normally expect to win in an arm wrestle? Well, the answer is obvious. We'd expect the strong arm to beat the relatively weaker arm. There's nothing wrong with that arm. It's just this arm is significantly bigger. It's at least double the size of this arm. So you'd expect this arm to beat the weaker arm. So if someone said to you, which arm is going to win? Most of us would say, well, the strong arm will win. We look to back the strong against the weak. When we're wanting, if you had to make a guess which one would win, you'd always think, well, it's the strong one. Now, this concept is the concept you need when you're trading, because we want to back a strong currency, right, against the weak currency, just as we're expecting the strong arm to beat the weak arm. We expect a strong currency to move against the weak currency. And whenever we're trading, we're trying to pair strength against weakness. Right, I'm going to show you a trade that I've just taken and a trade that I've entered, right, at market yesterday. Still can potentially be entered today, and I'll show you the rationale for it. Okay, so you can see how you go about this process. Now, this is not like me, bragging or showing off or anything like that. What this is me demonstrating how you use this core concept of trading strength, okay, against weakness. So without further ado, I'm going to take you over to my other screens, and I'm going to show you how I piece together a decent trade on the Aussie yen, right? So let's just look at that now. I'm going to go over to the other screen. Right, okay, you can see here the Aussie yen. Now, this is the trade that I've just closed out, right? You can see that after the last Reserve Bank of Australia meeting, it became very clear that the Reserve Bank of Australia had no reason not to hike interest rates, right? Now, last night, there was a comment from the Reserve Bank of Australia, which was quite telling, right? Governor Lowe, he said it's plausible the cash rate will be raised later this year, and they're closer to a point where inflation is sustainably in the target range, but not there yet. On my blog, if you look at the last interest rate decision by the central bank, you can just go along to my blog, follow it here, Central Bank Watch, and you'll see that I pointed out here on the 2nd of March, right, that the RBA has reached a turning point for Australian dollar buyers, right? I was saying, look, this is the break of this trend line is, looking higher, because what they said that inflation is not sustainably within our target range. But they also projected that the core inflation is going to drop to 2.75% over 2023. In other words, they saw inflation above the mid-range of their target band, which is 2 to 3% for 2 years. So you could reason to yourself, well, hang on, that looks very sustainable, right? So price moving higher made sense for the Australian dollar. Now you can see here that was the obvious target because you got the recent highs. Now the reason we're expecting the yen to be weak was for the following reason. There's 3 reasons for yen weakness. First of all, look at the bond yield. You see, the bond yield between Japanese 10-year bonds, the Bank of Japan has said they're going to keep it within that plus 0.25 minus 0.25% region. So that means every time the bond yield gets that high, the Bank of Japan buys bonds at unlimited amount. So they're not prepared to see the yield move above plus 0.25%. That structurally keeps the yen weak. Number 2, high oil prices. Japan is a net importer of oil. In other words, when oil prices are high, it makes things harder for the Japanese economy. That weakens the yen. High oil prices weakens the yen. Thirdly, if you look at inflation for Japan, you can see here, this is from my role as an analyst with Financial Source. It's a great report here that one of my fellow analysts, Arno, puts together. You see here the Japanese yen headline inflation is just 0.5%. Do you see that? So Japan is not fighting inflationary pressures. Japan is keeping bond yields low, and Japan is struggling with high oil prices. So all of that means that the Australian-Japanese yen pair could be reasonably expected to gain. And that's why I took profit at those recent highs. Now, we have a very similar trade opportunity here in the New Zealand dollar yen. Now, remember, the reasons for the yen weakness remain the same. Now, the New Zealand dollar has the most hawkish central bank of all the major central banks. And if you look at the bond yields for the New Zealand, not here, sorry. Let's get the right one. What have I done? What have I done with the bond yields? That should be it. Okay, I've accidentally closed the chart. Okay, bear with me. Sorry about this. I'll just open up the bond chart again. Right, take a look at this. This is what I want you to see. Look at the yield percentage on the right-hand side of the chart. And what you're going to notice is in New Zealand 10-year yields, you see it's approaching 3%. Now, the reason currency traders look at bond yields is because when bond yields are rising, that means interest rate hikes are expected to come. That strengthens the currency. Okay, so here we can see New Zealand 10-year yields surging higher, reaching up towards 3%, positive for the New Zealand dollar. Once again, if you look at my blog here, and if you look at the central bank watch, you'll see at the last New Zealand dollar meeting, look, I said more rate hikes to come, and the RBNZ have said that they might be having to hike interest rates at a faster speed. They projected their official cash rate up higher. They're expecting interest rates to be at 3.35% in March, 2.84% in June 2023. They're concerned about headline inflation, and they've said that they may have to, be buying, they may have to hike interest rates more quickly. Again, here's the New Zealand dollar yen, and this was way back in, when was this? This was 24th of Feb. Okay, so going back a long time, and you see that New Zealand dollar yen, I was expecting that to boost higher, right? Okay, as it has. So make sure you're following me along on this blog. I'll just send you that article there. Make sure you follow my blog, particularly the central banks. I make sense of what's going on with them now. And even before that meeting, you see what I'm saying is you could see that there was reasons for the New Zealand dollar to remain strong, right? And this was on the 11th of Feb. So I've been expecting New Zealand dollar strength for some time. You can see that it looks cheap, and you can see I was buying against the CAD. So when you put all that together, that means I've got a fundamental bias to buy the New Zealand dollar yen. Now I've been buying in structurally for some time, okay, but I've also just started a new trade yesterday with a hidden bullish divergence, with price making lower highs. So price makes higher lows, indicator making lower lows. So higher lows on price, lower lows on indicator. See how they marry up? That's typically higher prices. Stops can be placed underneath 78.35, just underneath that S1. Looking for a move up to 80 at the first test, right? So that is potential. I did get in yesterday from the lower prices, just around that 79 region. But also, if you look on the monthly chart, there is a hidden bullish divergence here on the monthly chart. See price making higher lows, indicator making lower highs. This is really setting up for a move, looking up back up towards 88.92. So this New Zealand dollar yen trade really does look good for the medium term. Okay. So you could enter at market stops just underneath 74.88 or underneath 74. Looking for a move back up towards 88. RBNZ expected to hike interest rates. Bank of Japan expected to keep interest rates. So now you might think that's fantastic, Charles. It's a no-brainer. There is a risk. The risk is if we see risk-off trading, we could see yen bids, and you can see this pair move lower. Now, even though we've seen risk-off trading on the geopolitical risk, the yen has remained weak for the reasons outlined, but that can change. And the New Zealand dollar, Aussie dollar, and CAD have all remained strong, but that's because of commodities moving higher. Remember, the New Zealand dollar, CAD, Aussie dollar are called commodity-based currencies. Look at copper surging. Look at iron ore prices surging, coal futures surging, oil prices surging, nat gas, okay, pulling back now with the latest headlines about nat gas supplies in Europe. But you see the picture. High commodity prices boosts the high betas, New Zealand dollar, Aussie CAD. So even though risk is trading off recently, on and off the last couple of weeks on the Russian-Ukraine crisis, we've still seen strong gains in those currency pairs. So if we just take a look at this over like the monthly chart, and if we look, okay, can we go see if we can go back? Let's look at the weekly, see if we can go back to like the 1st of March. A bit tricky here. We'll go up, let's see the daily charts. Yeah, okay, that'll help us. So March the 1st. So you can see since March the 1st, look, New Zealand dollar, Aussie dollar, CAD have been three of the strongest. New Zealand Aussie dollar absolutely ripping it now. Okay. Now, there's a lot more I could say on this, but I hope that gives you a good understanding of what's going on here. Remember, like that's the principle that we're looking at: a strong currency against a weak currency. So over the medium term, we now have a fundamental reason for New Zealand dollar strength against the Japanese yen from a structural point of view. All right, that does make an awful lot of sense. I hope that's clear. Now, with that all being said, I want to show you what's going on in equity markets today, so you understand what the big picture is in markets. Right. Now, the big picture in markets is as follows. You've got two major narratives going on. Narrative number one is that there's geopolitical risk. Narrative number two is that there's a risk of a global slowdown resulting in stagflation. What is stagflation? Well, stagflation is just very simply when you see an environment of slowing growth but high inflation. So let me show you. This is stagflation, when inflation is high but growth is slow. So what markets are concerned about is that geopolitical risk, which is boosting copper prices, oil prices, really sinking the euro at the moment, that all of that is going to result in potentially a European recession, that consumers will have less disposable income because of commodity prices impacting consumers, that central banks will be forced to hike interest rates to control inflation. That will slow growth further. So in that environment, stagflation environment, you tend to see gold doing very well, bonds being bought, oil doing well, dollar index doing well, consumer staples, because people still have to go to the shops, you know, doing well, and energy sector doing well, because people still have to use energy. Whether there's a recession or not, you've still got to drive to work, right? And the things that tend to do badly are, you know, base metals, things like, you know, copper, for instance, wouldn't be great because people are going to be doing less building work, materials, consumer discretionary items, so luxury goods, you know, high-end luxury goods tend to do badly because people haven't got the disposable income. People feel less confident, so they're less likely to spend their wealth. Financials tend to do not so good as well because, like, high inflation, low growth, so people are taking less loans, there's less financial activity, all of that impacts the bottom line of financial markets, right? So now you see what's going on. So it's not just a question of geopolitical risk, it's also the question of stagflation risk. That's why we've seen equity markets grinding lower. So the Russian-Ukraine risk, and then the concern, is this resulting in more risk off, you know, is this going to result in further selling in equities? What's going to happen? Obviously, you know, folks don't know. I could speak a lot about this, but I hope by giving you the big narratives that makes sense. Now, with all that being said, notice a couple of things. China's A50 is putting in some bottoming action. This looks extremely good value over the medium term. Unlike other central banks, the People's Bank of China is cutting interest rates. The Chinese government is due to have fiscal stimulus for the Chinese economy. Now, what the worry here is China is quite closely allied with Russia. They haven't got a formal agreement, but China has been very kind of understanding of Russia's position with its concerns over NATO expansion. And shall we say that Russia has also been very understanding about Chinese worries and interests about Taiwan. China wants Taiwan to be part of China again, and Russia wants Ukraine to be part of Russia again as it sees it. Now, I'm not getting into the politics of it. I'm just saying that both of them have found some consolation with one another. China announced this week that it might consider buying some discounted Russian energy stock. China could potentially benefit from cheap Russian oil that Russia isn't able to sell elsewhere. The proximity of China and Russia could mean that global investors decide to shun Chinese investments. That's why we see that heavy sell-off overnight. The sovereign wealth fund didn't invest in some Chinese stock last night. And the worry is Norway's sovereign wealth fund is, you know, one of the largest funds in the world, huge. So they declined to invest in some Chinese stock last night, and investors thought, oh my goodness, if investors shun China, then that's terrible. So financial conditions are good for Chinese growth, but there's that geopolitical risk. So we've got 36% falls from last year. That looks really good value. And as long as, if this crisis fades, that looks great to buy at market. Stops just underneath 12,900. It can be carefully defined. Now, let me explain to you what would boost equity markets. Now, the geopolitical risk, this is what's going on, right? So Russia fear NATO. NATO countries are in the blue. Russia's argument is that when the end of Second World War, NATO agreed not to move further east. Since the end of the Second World War, you can see that NATO has moved further and further east. Now, NATO, part of the pact is that an attack on one NATO country is an attack on all of them. And the reason that NATO was formed, the North Atlantic Treaty Organization, was trying to stop the World War developing in Europe again. We had World War I, World War II, and countries have got enough, they're sick of this, so let's try to end it. So NATO was formed to try to end conflict. Russia is not part of NATO. The US is also part of the NATO agreement, and the US is very much opposed to Russia's expansion east. Now, Russia has expanded by proxy into Belarus, which is very pro-Russian. And this is where Ukraine comes in, right? Russia doesn't want Ukraine to join NATO because then NATO has a tight border with Russia. And Russia doesn't like all these NATO countries because it means it takes, you know, one boot outside Russian territory and it triggers a war. So Russia fears, you know, missile bases being on, you know, NATO territory. That's Russia's concern. So when you understand that, the headline we're looking for, we saw one last night. I'll just show you this, if I can get there. I can't get there, it'll take me too long. But what I can tell you is Ukraine said, and this is what boosted the risk sentiment last night, you know, we're prepared not to necessarily join NATO. That's what Russia wants. Russia wants Ukraine to not join NATO because it means it gives a buffer between the body of NATO countries and Russia, with Moscow's up here somewhere, right? So if we see Ukraine, this is the kind of deal that would be positive for risk. If Ukraine's President Zelensky comes out and says, right, we've got a deal, Crimea, which is down here, becomes part of Russia. Donetsk and Luhansk, these two breakaway states, become independent states. In other words, they're a bit like Belarus. They're independent, but pro-Russian. And Ukraine says we won't join NATO for the next 25 years. That will probably be enough to pacify Russia. Right? Now, the cynics say what Russia wants is they want to overthrow Ukraine and make Ukraine like Belarus. And basically, Belarus is pro-Russian. So you see here, you've got the Russian key, you've got the Russian air defense. Belarus is pro-Russian, you've got Russian troops in Belarus. And remember, some of Ukraine was, some of the Russian troops came in from the north in Belarus, right? You see the issue. So what we're looking for is Ukraine such, if there's a compromise, if Ukraine's happy, that's the positive. If Ukraine say, right, we're happy, we struck a deal, and that's the the reasons that are given, then we'd look at like equities should surge, and look at like China's 50 looks a lovely buy at market, right? FTSE 100 look great value. The DAX, the Euro stocks look good. German DAX and Euro stocks and FTSE 100 are better value than the US stocks, because you see US stocks didn't fall as heavily as the European stocks. The European stocks fell more heavily because of their proximity to Russia. Right, folks, you should now have a good key what's going on. Now let's cover the ECB quickly. ECB are worried about rising inflation. This was the last inflation print that came out last week. See, Euroflash estimate came in 5.8% year on year. That was higher than the 5.6% expected. That has got the Eurozone worried. We've had 3 Eurozone board members saying that stagflation is a risk. Prior to the Russian-Ukraine crisis, the ECB were expected to turn more hawkish tomorrow. They have a problem, and the problem they've got is that inflation is high, but growth is slow. Now, what are they going to do tomorrow? Are they going to say, okay, we recognize the inflation risks, so we're going to have to turn more hawkish? And what will be more hawkish? If they signal a rate hike this year, they expect the euro-US dollar to rally up to 1.100 straight away. So one potential opportunity here is it is possible to buy in at market with stops below 1.078790, expecting a potential retracement. Now, the euro was sold off heavily on the Russian risk, losing 7.5% since the start of the month. But the ECB's meeting tomorrow, and they could, they're most likely to kind of delay a bit and sort of say, well, we'll have to see how this Russian crisis pans out. But I think inflation is still going to be a concern. And if you look at German inflation here, you can see that the German inflation, this is the break-even inflation at 5 years, is right up with the US break-even inflation levels. So this tells us that German inflation is high, the Eurozone inflation is high. It'll be hard for the ECB to ignore. So this is not a trade I'm in, but it is a possible trade to take the euro-US at market, or maybe slightly the dip lower down to 1.0932, stops just below 1.707900, looking for a more hawkish ECB tomorrow. More hawkish would be if they signal interest rate hikes this year, they signal the end of asset purchases in the 3rd quarter or the 4th quarter of this year. If they announce, it's expected that they announce the end of the pandemic emergency bond program. That should be announced to end this month. But then the asset purchase program, the normal quantitative easing, they should announce that be ending about the 3rd quarter, the 4th quarter. They may be hazy on that due to Russian risk, or they may say, well, actually, inflation is so much of a concern we have to deal with it. But then you have the stagflationary concern. So there's a lot of moving parts. Euro's very heavily sold, so seeing some kind of retracement here does make a little bit of sense. That is a potential opportunity into the ECB rate meeting. Folks, it's been an absolute pleasure as always. I hope that's been helpful, and I hope that's got you guys up to speed, and so you know what those big pictures are, you know what's driving markets. So hopefully you shouldn't be surprised. You're keyed into those big drivers, those big movers. Been a pleasure, everyone. Please have a wonderful day, and don't forget, I'm back here on Monday. We'll look at the FOMC Fed meeting next week, and the Bank of England are both meeting next week. So come back on Monday and we'll start getting ready for that event and what we can potentially look at. You know the positive risk we need to see for a de-escalation of the Russian-Ukraine crisis, looking for NATO Ukraine to accept they won't be part of NATO, looking for some kind of announcement from President Zelensky on that line would be the most positive for risk at the moment. Take care. Have a very good afternoon. Thanks everyone now. Goodbye.